Everyone is told to diversify. Financial advisors say it, investment books repeat it, retirement plans enforce it. Diversification is framed as universal wisdom. The safest path, the responsible choice, the intelligent strategy. And for most people, it works exactly as designed. It protects what you have. It does not create what you don't. There are two distinct financial objectives: wealth creation, wealth preservation. They require opposite strategies. Wealth creation requires concentration, asymmetric exposure to one or few positions, high conviction and limited opportunities. Wealth preservation requires diversification, spreading risk across uncorrelated assets, minimizing drawdown. Most people are told to diversify while still in the creation phase. This is not accidental. It serves a different incentive structure. Diversification produces market returns. Beta, the average. When you hold the entire market, you capture market performance. No more, no less. Wealth, asymmetric wealth, comes from alpha. Returns above market average. Alpha requires deviation from the market. Concentration in positions the market has not yet priced correctly. You cannot capture alpha and eliminate concentration risk simultaneously. The two are structurally incompatible. Financial advisors are not optimizing for your wealth acceleration. They are optimizing for client retention and liability management. If an advisor recommends a concentrated position and it fails, they face legal and reputational risk. If they recommend diversification and you underperform the market, they face no consequence. Because you performed with the market. Diversification is the safest recommendation for the advisor, not necessarily for the client. The system rewards advisors for risk mitigation, not for asymmetric outcomes, so they recommend what protects them, and call it prudence. Every significant fortune was built through concentration. Real estate concentrated in one geography. Equity concentrated in one company. Businesses built in one sector. Bezos, Amazon equity. Musk, Tesla and SpaceX equity. Buffett, Berkshire concentration for decades. None diversified during wealth creation. They diversified after. Most concentrated bets fail. A small number succeed disproportionately. That asymmetry is the point. But the story you hear is incomplete. You hear the outcome. You don't hear the structure that produced it. So you're told to diversify from the start, which guarantees you never replicate the structure that built those outcomes. Diversification is a preservation tool. It minimizes volatility, it reduces maximum drawdown, it smooths returns. If you already have wealth, this is optimal. If you don't, it locks you into linear accumulation. Index funds return 7 to 10% annually. Compounded over 30 years, that produces moderate wealth, not asymmetric wealth, because asymmetric wealth requires asymmetric exposure, and asymmetric exposure is the opposite of diversification. When you allocate capital across 10 positions, each position receives 10% exposure. If one position appreciates 10x, your portfolio gains 100%. If you allocated 100% to that position, your portfolio gains 1,000%. The difference is not risk tolerance. The difference is strategic clarity. Diversification reduces your best outcome to protect against your worst. That trade-off makes sense when preserving capital. It does not make sense when creating it. Because creation requires tolerating concentration risk. The confusion happens because advice does not account for stage. Early accumulation phase historically produced asymmetric outcomes through concentrated exposure. Late preservation phase requires diversified exposure, but most people are given preservation advice during accumulation. Max out your 401k. Buy index funds. Rebalance quarterly. This is sound advice if you have $2 million and want to protect it. This is limiting advice if you have $50,000 and want to build it. The strategy that protects wealth is not the strategy that creates it, and the financial system does not distinguish between the two, because it profits from managing assets under preservation strategy, not from enabling concentration. Diversification benefits institutions. It creates predictable, manageable portfolios. It reduces advisor liability. It generates fees on assets under management. It prevents clients from taking concentrated risks that might lead to exits or lawsuits. The client remains safely invested, safely underperforming those who concentrated, but underperforming predictably, which is acceptable in the institutional model, because the institution optimizes for client retention across thousands of accounts, not for individual asymmetric outcomes. If you have followed diversification advice and your portfolio has grown steadily but not asymmetrically, if your returns match the market but never exceed it, if your wealth grows linearly but never exponentially, you were not wrong. You were using a preservation tool during a creation phase. This is not about intelligence. This is not about discipline. This is not about market timing. Diversification protects. Concentration creates. If you diversified early because that's what you were told to do, you weren't being prudent. You were following institutional incentives that do not align with asymmetric wealth creation. That's not a portfolio problem. That's a strategy misalignment problem. That's the structure.